India has just made a significant change to its stock market regulation, but surprisingly, not many people are talking about it. For years, a special route called the Portfolio Investment Scheme or PIS was available mainly to NRIs and OCIs. Now, India has opened this route to all non resident investors across the world. Could this bring more foreign money into Indian stocks? Will it boost liquidity? And what does it mean for mutual fund investors and the broader market? Let's break it down in simple terms. What is PIS? Before we discuss the change, let's first understand what the Portfolio Investment Scheme actually is. PIS is a framework regulated by the Reserve Bank of India that allows eligible overseas investors to buy and sell shares of Indian listed companies through Indian stock exchanges. Think of PIS as a regulated entry gate through which overseas investors can participate in India's stock market. The scheme comes with investment limits, reporting requirements, and regulatory oversight to ensure transparency and compliance. Now, let's see how things worked earlier. This is where the story gets interesting. Until now, the PIS route was largely restricted to two categories. One, non-resident Indians or NRIs. Second, overseas citizens of India or OCIs. For example, an Indian citizen working in United States or a person holding OCI status in Canada could invest in Indian listed shares through the PIS route. However, suppose an American investor, a Japanese investor, a Singaporean investor, or a German investor wanted to invest directly as an individual in Indian stocks. In most cases, the PIS route was not available to them. Instead, foreign investment in Indian equities primarily came through foreign portfolio investors or FPI framework. FPIs are generally large institutions such as global mutual funds, pension funds, insurance companies, sovereign wealth funds, and asset managers. So, foreign capital was already entering India, but direct participation by overseas individuals was relatively limited. In simple terms, the special gate called PIS was mainly open to NRIs and OCIs, while most foreign investors had to come through large institutional channels. What has changed now? On June 12, the government amended the foreign exchange management rules and removed the long-standing restriction that limited PIS investments mainly to NRIs and OCIs. Now, all eligible non-resident investors can access Indian listed equities through this route. Let's look at it simply. Earlier, PIS access was available to NRIs and OCIs, but not to most foreign individuals. Now, PIS access is available to NRIs, OCIs, foreign retail investors, family offices, and other eligible overseas investors. In other words, India has widened the entry gate to its stock market. However, this is not completely unrestricted opening. The government has retained certain safeguards. Investments involving entities from countries sharing the land border with India or cases involving sensitive ownership structures will require prior government approval. Why India is doing this? Yes. So, why the government introduced this change? The answer is straightforward. India wants deeper and more mature capital markets. The government wants to attract a broader pool of global investors rather than relying heavily on a relatively small number of large foreign institutions. At a time when both FDIs and foreign portfolio flows have been softer compared to previous years, expanding investor access can help make India markets more attractive to global capital. How does this benefit the stock market? Benefit 1. More potential capital. The most obvious benefit is to a larger pool of money. When more investors are eligible to participate, the potential demand for Indian equity increases. This gives listed companies access to a broader investor base. Benefit 2. Better liquidity. Liquidity refers to how easily shares can be bought and sold without causing large price movement. When more investors participate, trading volumes can increase. bid-ask spread can narrow and price discovery becomes more efficient. This is particularly beneficial for mid-cap and small-cap stocks where liquidity is often lower. Benefit 3. Reduced dependence on large FPIs. Currently, foreign flows are heavily influenced by large institutional investors. When a few large institutional funds buy or sell aggressively, markets can experience sharp movements. A broader investor base creates more diversification and reduce dependence on a small group of investors. Benefit 4. Easier fundraising for companies. When companies have access to more investors, raising capital becomes easier. They can raise funds through follow-on public offerings, qualified institutional placements, and other equity issuance. Lower fundraising costs can support business expansion, innovation, and mainly job creation. Benefit 5. Positive global signal. Perhaps most importantly, this reform sends a message that India is becoming increasingly integrated with global capital markets. It reinforces India's image as an investment destination that welcomes international investors while maintaining regulatory safeguards. Now, what does this mean for mutual fund investors? For mutual fund investors, the impact is likely to be indirect rather than immediate. Greater participation can lead to better market liquidity, more efficient price discovery, important access to capital for companies, and stronger market depth. Over time, these factors can contribute to healthier corporate growth and potentially stronger performance for equity mutual funds. However, this is a long-term structural benefit rather than a short-term trigger. Are there any risks? Of course, every reform comes with a risk. Foreign investors can move capital quickly across markets. During periods of global economic uncertainty, interest rate rising, or geopolitical tension, foreign capital can flow out just as quickly as it flows in. This can increase market volatility. That is one reason why government has retained security checks and approval requirements in sensitive cases. So, will this change trigger an immediate stock market rally? Probably not. Large institutional investors already have established routes such as FPI frameworks to invest in India. The real significance of this reform lies in its long-term impact. By expanding access to overseas investors, India is taking another step towards building deeper and more liquid and globally connected capital markets. The potential chain reaction is simple: more investors, more liquidity, better capital access for companies, stronger capital markets, stronger economic growth. This is less about short-term market move and more about strengthening the foundation of India's financial markets for the future. What are your thoughts on this reform? Do you think it will meaningfully increase foreign participation in Indian equities? Let me know in the comments.